but I'm recording now. So thanks for that reminder. So I'm still going to talk about finances, if you guys are okay with that. And before I want to talk a little bit about mutual funds. I want to address bonds with you guys a little bit. And then I want to address retirement funds, kind of a couple of different options. You guys okay with that agenda?
Sounds good.
Yeah.
All right. So awesome. Thank you. Thank you. So let me share screen. And I'm going to talk a little bit more about mutual funds. So let me get up my Excel. You guys see my Excel thing here?
Yep.
Awesome.
Yeah.
So as I'm pretty sure I said last week, a mutual fund is a fund of money that is funded by its shareholders. So if you guys all gave me, and don't you dare, but if you guys all give me $1,000 to manage, I'd have 30,000 bucks. And if I invested that $30,000 into Tesla stock, we would have a Tesla mutual fund. If I took the 30,000 and invested in bonds, we'd have a bond mutual funds. If I took the 30,000 invested in, you get the gist, right? Into high cap stock, large cap stocks, we'd have a large cap mutual fund. So what I invest your money in, or the fund owner's money in, determines what kind of mutual fund we have. And here what I have is on the spreadsheet in front of you. And I just put some completely arbitrary numbers together. I say, let's say we invest in stocks. It's not a bond mutual fund, it's a stock mutual fund. And it's a little one. And I have $1 million of stocks, different kind of stocks, all add up to $1 million bucks. And then I borrowed $200,000 on my margin account. And that's part of the money I used to come up with this $1 million worth of stock. And remember, with your stock track, you were each given $100,000, right? I mean, to start with, and you could also borrow $100,000. So you had $200,000 of money. And in this case, I've used 200,000 of borrowings, and then 800,000 is the money that has been invested, has been entrusted to me as the fund manager to invest. So remember the balance sheet I asked you guys to do beginning of the semester. So the assets are $1 million bucks, and liabilities 200,000, equity 800,000. And remember the balance sheet equation. Can you guys see that? Total assets equals $1 million bucks equals total liabilities 200,000 plus equity 800. 200 plus 800 equals $1 million. So that's a balance sheet of a mutual fund. Any questions on that? We good? So let's say we started off this mutual fund by selling shares at $25 a share. And we therefore, if I take this 800,000 that we amassed, and so plus 800,000 divided by 25, I sold 32,000 shares at 25 bucks a share, right? Are we good?
Yes.
All right. So a couple of things about that. Whoever bought these shares at 25 bucks, if you bought one share, you invested 25 bucks, you got immediate diversification, right? I mean, for $25, you couldn't buy a Tesla share. Remember last week we looked at Tesla, like 400 something dollars a share, right? 25 bucks, you couldn't even buy one share. But by investing the money in a mutual fund, and let's say the mutual fund invested, among other stocks, invested in Tesla, and you can have an industry specific mutual fund, sidetrack, like this fund only invests in automotive stocks. So it'd be Toyota, Honda, Ford, General Motors, Tesla, yeah, Chrysler, whatever. Or this could be a not industry specific fund. It could be really diversified. It could include Tesla, Microsoft, Bank of America, Exxon. I mean, all over the place, right? So when you invest in a mutual fund, you get immediate diversification. That's a benefit of investing in a mutual fund. Not all your eggs are in one basket. And the other thing you get professional, meaning somebody gets paid to manage your money. That's their full-time job. They're not working somewhere else and doing this in the evenings when they have time or at lunch hour. This is their job. Their job is to make this pool of assets that they have, these stocks in this case, increase in value, right? Pick the right ones. We good about that?
Yeah.
Okay, so this is a little repeat, but if you have any questions, don't hesitate to ask, right? Feel free to interrupt. You're not interrupting, you're be part of this. So, so now let's put up a scenario where the stock manager has done well and has grown this bundle of money from $1 million over a period of, say, a year to $1,300,000. It could be anything, as I'm obviously making this up as I go. And, you know, you issued 32,000 shares initially. So what is the value of each share? Well, it's the, so it's the equity. See, the equity grew. The debt didn't grow. It stayed at 200,000. The assets grew. Sorry about this. Okay, rewind. The assets grew from $1 million to $1.3 million. I just changed it. The liabilities didn't change. So again, for the balance sheet equation to work, my assets went up by 300,000. Liabilities did not go up or down. So therefore, for this equation to work, the equity had to go up by 300,000, and it went from 800,000 to $1.1 million. Right? You saw that change? We good?
Yeah.
Yeah.
Okay. So now we have equity of $1.1 million. We had previously issued 32,000 shares. So if I divide this equity by the number of shares that we had issued, take H8, which is the $1.1 million, divided by H12, the 32,000, my shares have now increased in value from $25 a share to $34.38, right? And this way of valuing the shares, which is just take the assets, subtract from the assets the liabilities dollar-wise, what's left is the equity, divide that equity by the number of shares. That value per share is called the net asset value, or NAV for short. Okay with that?
So it's like the value of those went up by like almost $10.
Yes, it did. It went from $25 to $34.38. Yes.
Okay, thank you.
Yes. So increase. Oops. Increase. Can't share. Can't type. Increase in value per share is 34 minus 25. Went up by $9.38. And percentage increase in value is, of course, 30%, right? I went from $1 million to $1.3 million, but if I take the 938 and divide it by 25, our beginning number, I get, oh, no, it went up by 38%. I'm glad you made me do this. The reason it went up by more than the assets went up by 30%, but your equity went up by 38%. The reason it went up by 8% more than the asset is because your liability stayed the same. So this is the power of leverage, right? Oh, okay, we got a sidetrack. Sorry, guys. I'm so glad you asked that question. You buy a house. Okay, I'm going down a rabbit path, class. You buy a house, bear with me, and you buy a house for $250,000. And your down payment is 20%, right? Let's just say you put up 50 grand. So therefore your loan or your mortgage is 200,000, right? You put in 50 grand of your own money and you borrowed 200,000. All right. So now let's say a house goes up in value. And it goes up to $275,000. Oh, are we okay with this? So increase in value is 275 minus 250. And percentage increase is the 25,000 divided by my starting point. So it went up by 10%. But my equity increase which is it increased by 25,000, but the equity percentage increase is 25,000 divided by 50 is 50%. The house goes up in value by 10%, which is 25,000, but my loan amount doesn't go up, right? My loan amount stays at 200,000. So that increase in asset, just like with the mutual fund, this went up by 25,000. That increases my down payment or my equity. Yeah. So my equity went from 50 to 75,000, which is a 50% increase. So that's the power of leverage. If things go well. Now, let's say things go badly and your house drops in value to, hold on, before I do that, any questions on this?
So how did you get that equity increase, like, number?
Great. So thanks for asking. So remember the balance sheet equation, assets dollar-wise equals liabilities plus equity. Are you good with that?
Yeah.
Okay. And I'm saying the assets went up by 25,000. Right?
Yeah.
Because the house went from 250 to 275. My liabilities didn't change, right? I mean, I don't owe any more to the bank because my house went up in value. So liabilities went up by 0. And then my equity, therefore, for the balance sheet to balance, what had to go up? Right? If my debts didn't go up, but my assets went up, my equity went up, didn't it?
Yeah, but how did you find that 50%? Like what was the
Oh,
formula for
okay,
that?
okay. So now you agree that my equity's gone up by 25,000, right?
Yeah, yeah.
So, all right. So I was at 50,000, agreed? My equity.
Yeah.
And it went up by 25,000. So now my
Also,
equity, ending equity is 25,000 plus 50,000. That's 75,000, right?
Yeah.
And 25,000 divided by 50,000, right? It went up by 50%.
Yeah, I forgot down payment was equity. I'm sorry.
Oh, no, why are you sorry? I mean, listen, I love the fact you asked the question. Because I talk too fast, and I guarantee you half the class had the same question as you did. So the down payment is your beginning equity, right? It's your own money in the deal. Your loan is your loan, your liability. We good?
Yes, thank you.
Yeah, you're welcome. Any other questions before I give the other scenario? So let's say, I'm just going to say, instead of go up, I'm going to say changes in value. And now I'm going to say the house went down in value to 225. So you lost 25 grand. That's a 10% decrease in value. But your equity now is instead of being 50, it got slashed by 25,000. It's only 25,000. So you lost 25,000, right? The house lost value, 25,000. Your equity lost value, 25,000. You just lost 50% of your money. You lost half your money with a 10% change in price. So what the use of debt does, it amplifies the effect of changes in the value of the asset on your equity, right? A 10% change in this example, because you have 4-to-1 leverage. For every dollar that you put in, you borrowed 4, right? You put in 50,000, but you borrowed 200,000, 4 times as much. Yeah. It amplifies the effect. When the asset goes up by 10%, your equity went up by 50%. When the asset went down by 10% down, the equity went down by 50%. If the value of the house drops to 200,000, what happens to your equity?
It's gone.
It dropped.
Gone. You lost 50,000, your ending equity is 0. You lost every penny. Okay, as far as impact of leverage. So leverage is great if you're investing in something that is going to go up, right? Leverage is dangerous if you're investing in something that's going to go down, because your asset value, when it goes down, again, it doesn't change the debt. Even your stocks went down, but you still owe what you owe. So I shouldn't give names, but I was working at a bank, and there was a guy who, so I won't tell you which one. There was a guy who had this brilliant idea, he thought, and invited customers over, and he was encouraging them to, hey, let's do this. Interest rates are low. Let's refinance your house, right? Get money out of your house. You're only paying 3-4% on your mortgage, right? 3-4%. Stock market has made historically 12% return, which what I've been telling you guys, right? Right. So, hey, pay 3%, 4%, make 12% on other people's money. Wow. Right. If the stock market goes from 250 goes up by 10% to 275, you're going to make 50% on your equity, right? And you're only paying the bank 4. Woot, woot. You ought to do this. So what happened? People listened to that advice. And what happened? The stock market in 2008 crashed by 50%. So forget the value going up by 10%. It smashed to 125,000. Whatever. So that's a loss of 125,000 in value, 50% drop. you borrowed money, right? But now you owe $75,000. Well, if you borrowed the whole 250, you now have $125,000 that you owe with no asset to back it. How are you going to pay the 125,000 back? And not going through the stocks, at least not immediately, right? And now eventually the stock market came up, but you had to have the buying power to serve that mortgage, right? And not panic and hold on. And so a good advice is never borrow to invest in stocks. So even though with Stock Tracker you have the ability to do that, I just want to show you the danger of doing that. So that's a rabbit trail. I didn't expect to talk about that, but that's all because of a question in class. So thank you for doing that. Yeah, for giving me the question. We good? I mean, I don't know about be good, but any questions on, did that make sense?
Yeah.
Kind of, sort of. Ask me if I spoke too fast. Okay, back to mutual funds. Fair? So there are all kinds of mutual funds. In fact, there are more mutual funds out there than there are stocks, which shouldn't surprise us because mutual funds are combinations of investments, right? And if stocks were to be letters in the alphabet, there are more words out there, combinations of letters, than there are letters, right? Only 26 letters, or however many we have. But how many words do we have? No idea. Right? And then combinations of those words, combinations of combinations. Oh, now we're infinite. Right? So there are more mutual funds than there are stocks or investment possibilities because there are more ways of grouping them together. But one way to categorize mutual funds is to refer to them as open-end or closed-end mutual funds. So let me talk to you about those two categories. Open-end or closed-end mutual funds. Two types. An open-ended mutual fund is one where if you buy this $25 a share investment, buy the share in this mutual fund, that $25 goes to the fund manager, goes into the fund, and if you buy a share for 25 bucks, then the number of shares goes up to 32,001, and you're assuming that gets invested immediately, or it's sitting in cash. Your total assets now $1,025,000. So that's called an open-end mutual fund. And if you want to sell, get out. You want to sell, and you can sell it for net asset value. It's easy to calculate the net asset value. Showed you how to do that. It's the mutual fund that'll pay you the 25 bucks if that's what it's worth or whatever, and get your share back. How are we with that? That's called an open-end mutual fund. Questions?
Could you repeat that again?
Yeah. So an open-end mutual fund is a mutual fund where the doors are open, meaning they'll accept new investors. So if you're a new investor, you want to put money into this mutual fund, they'll sell you a share, right? Or how many shares you want. And the money that you pay for that share goes directly into the mutual fund. Fair?
Yes, thank you.
Yeah, you're welcome. And if you want to get out of the mutual fund, you want to sell your share, it's the mutual fund that'll give you the 25 bucks or whatever your share is worth to get your share back. You're dealing with the mutual fund, buying or selling shares. Did that make sense?
Yeah.
Cool, cool. A closed-end mutual fund is one where the mutual fund manager has made the decision, hey, I got enough money. And if anybody were to, and I don't feel comfortable buying any more shares of Tesla or something, you know, I'm already, you know, I got what I am comfortable with. If I were to get more money, I'd have to figure out what else am I going to buy? And I just don't have capacity. I'm already following enough stocks. I'm already comfortable with what I've invested. I don't want to manage any money. I'm closing the doors. Okay. So a closed end is not open to receiving more money. Wait a minute. Right. Okay. Is that possible? Yes. A mutual fund manager can do that. And now what happens is, let's say you want to, wait. I want to, this is a great performing mutual fund. I want to buy some shares. Who would you buy the shares from?
Other people.
Other people who own it. Exactly right. Good answer. Other people who own it. So you'd have to find someone who's willing to sell, right? For you to be able to buy it. And where do you find that? In the market. And so closed-end mutual funds are traded in the market, just like stocks are. Now this is interesting. What are they traded for? Now you can calculate the net asset value, right? But if you have a mutual fund manager that is doing badly, why would you want to buy shares in that mutual fund? Right? So if somebody wants to sell it, they're going to sell it for below net asset value. Why? Not because the assets are less than the net asset value. No. They can sell the shares for less because the fund manager, pardon my French, sucks. He has a terrible record. And nobody wants to put money with them unless they get a deep discount. Conversely, let's say the fund manager rocks. You got to be incented to sell your shares, right? And sales of closed-end mutual funds that are doing really well, those shares sell above net asset value. So all that drama just to say that with closed-end funds, the value of the share is not necessarily determined by the net asset value, what it actually is worth, what it can be calculated to be worth, but it's based on demand and supply. The more people want in, the higher the value of that share. The more people want out, the lower the value of that share. Questions? Good?
Yeah.
Okay. Now I want to talk to you about, did we talk about load and no load in last class? I think we did. Remind me.
I think we did.
I think we did. I think we did too. So let me share something with you guys, which I didn't expect, but hey, there it is. I'm sorry. Let me go back to Excel. When we did the load thing, I explained to you how a load means you're paying an upfront fee in order to get into the mutual fund. So if you're investing $5,000 and the upfront fee, in class we said 4%, but I'll show you where I got the 5.75 from in a moment. If the fee is 5.75%, that's $287.50 that gets taken right off the top. So what is left for you to invest out of the 5,000 is $4,712.50. And if the mutual fund is selling its shares at 25 bucks a share, you end up buying 189 shares, right? Which is the 4,712 of investable money after they take out their fee, their load, divided by the 25 bucks. So you buy 189 shares. This is review. I mean, the load is different, but we did this in class. And if the price of the mutual fund goes up from 25 to 35 bucks, then the value of your 189 shares is 189 times 35, which is, I mean, it's the formula is in Excel, so trust Excel. It's 65.97. And again, you invested 5,000. That's what you started off with, right? I mean, even though not all of it went to work, but the money that left you, wrote the check, $5,000. So that you gained whatever the difference is between 65.97 and 5,000, which is 15.97, right? And 15.97 divided by your initial investment of $5,000 is 32%. I went really fast, but you guys okay with that?
Yes.
Can you repeat the last part one more time?
Yeah, sure. So are we good with the fact that your investment went up to $65.97, which equates to a $1,597 gain?
I just want to know how you got the 32%.
Okay, yeah, sorry. I apologize. So we're good with the $1,597 gain. So what you do is you take the $1,597 and you divide it by your initial investment of 5,000. So it's F10, which is this thing, divided by F4, which is this thing. And that gets you the 32%.
Okay, thank you.
So in general, when you want a percentage gain or loss, you first have to calculate the gain, fine. But you take that gain and you divide it by the investment that you started off with, or the investment at the beginning of the period that you're considering, right? It's the beginning investment. You don't divide the 1597 by what you have left over, which is 6597. That's misleading. You divide the gain by your beginning number. We good with that?
Yes.
Okay. All right. So, and then I made the bold claim, right? That, hey, if you didn't have a load, then all of your $5,000 would go to work. So you buy 200 shares, not 189 shares. You'd get more shares. And if those shares went up to 35 bucks, you'd end up with $7,000, not 65.97. Your gain would be 2,000, not 15.97. And your percentage gain now is 40%, not 32. So if the fund performs, the no load fund has the same gain as the load fund, you're going to do much better with a no load fund. Again, Captain Obvious, but I just want to quantify, show the impact of that, right? Does that make sense? Class?
Yeah.
Yes.
Okay, thank you, thank you. All right, and now, all right, so, so where does the load go to? Was the other thing I talked about. The load goes to the broker and the institution that the broker is working for, who is trying to convince you to put your money in this fund, the load fund. The load does not go to the mutual fund. The load goes to the guy who's trying to, the person who's trying to sell you the share to you. And so, you know, if he works for Wells Fargo, then half of this, say, goes to him and half of it goes to the bank. So how can they convince you to pay this fee? What do they have? What's the argument they got to make for you to say, okay, I'm willing to do that?
Maybe the money's more secured.
Safer, okay. All right, so that would be a function of the investment mix that that mutual fund has, and it'll also be a function of something else, which I'm trying to solicit from you. What else? What would make the fund safer? What they invest in and anything else? Back to my original question. How can I convince you to pay this fee? What do I have to convince you of?
That it will make more money.
Bingo. That you're going to make a higher return, even though you're paying a higher fee, you're going to more than make up for that higher fee that you pay by the higher return that you're going to get in this fund versus another fund. And right? So they got to somehow be able to convince you of that. Did somebody have a question? Did I cut you off? We good? Okay, so now let me share the thing which just had me chuckling. I'm gonna go to, oops. Remember Kiplinger? We went to, I just put it on Google, top performing mutual funds. And one of the choices, I didn't want to go to an actual mutual fund, a site where they sell mutual funds. I wanted to go to, for lack of a better term, a little more objective place. And Kiplinger is a news organization, so to speak. They don't sell their own funds. And here is the Ridgeworth Aggressive Growth Stock Fund, right? Which this last year doubled the money, 107% return, you know, not a 30% return, but you doubled your money. And then over the last 10 years on average, had a return of 20.85% every year, right? Do you see this?
Yeah.
Okay. And now here's the sales charge. Sales charge is another word for load. That's where I got the 5.75 from. This is a load fund. So it just seemed, in general, it's not worth paying the load. I'm just telling you, but here in this example, okay, hey, I'm looking it up. I'm showing it to you. You know, reality is stranger than fiction sometimes, but here's reality. Questions on that? Now, down here, the American Century Focused Dynamic Growth, whatever, investment fund has no load, and it provided a 10-year return of 18.29% versus 20.85, right? Can you remember that for me? 20.85 versus 18.29. And here is what I did under the balance sheet. Oh, you don't need to remember it. I had it here. Right? 20.85 versus 18.29. So let's say you start off with $5,000, right? Sorry to go all over the place. And you're paying your 5.75% load. So the amount of money that actually is going to go to work for you in that top ranking mutual fund is not $5,000, it's $4,712.50, right? So bring your calculators out, please. Your phones, you know, with the calculator app. Can you do that, please? So remember on your phones, you got that gray row and you got these 5 functions, PV, and not in this order, but anyway, future value and for number of periods, actual payment, if you adding anything, and the interest rate, right? What's your PV? Of course, it's there in front of you, but what's your initial investment?
$5,000.
Okay, but how much of that is going to work for you in the load mutual fund?
4,712.
Yeah, so that's your present value. That's how much is going to work for you. Fair? You're starting off at a disadvantage. Not all your $5,000 is going to work for you because you got to pay the load, you got to pay the fee. So in your calculators, if you don't mind, put in 4,712.50 and hit present value. And negative, right? Because the money's leaving you, it's going into the mutual fund. Are you guys keeping up?
Yes.
Yeah.
Excellent. Now, again, we're looking at a 10-year track period. So what's N?
10.
10. So type in 10, hit N, right? Now, we're not going to put any more money into that fund. It's just our initial 5,000 or actually 4,712, right? That's it. So our payment is going to be
Would it be 0?
0, correct. Because we're not adding more money, right? It's this initial investment and then hands off. And what is IY? Well, hold on. It is, Taraj, okay. Ordinarily 20.85, but I forgot to say something. So this fund up here, here's that 5.75% load. But see that over here, that other column is called an expense ratio. Do you see that?
Yes.
Okay. The 5.75 goes to the broker, like I said, who's selling it to you. But the 1.26 that's what the fund manager charges. That includes his or her salary. That includes advertising expenses, the cost of, printing the brochure that you get when you invest in the fund, right? Cost of the accountant that does the math or the tax returns, cost of the attorney, cost of, if you have an admin assistant, whatever. All those costs of running the fund, cost of the trustee, all of that stuff, that is covered in this expense ratio, which in this case is 1.26%, which is not bad. But when it gives you these returns, right, whether it's 107 or 20.85, whatever period you're looking at, these returns are before these expenses. Always. And of course, what matters is not what you get. What matters is what you keep, right? So 20.85 is what they say we got for you, but then they took out 1.26% of it to cover their expenses. So that what you got working for you is 20.85 minus 1.26. We good with that?
Yes.
Okay, let me go back to my Excel. So this rate here of 19.59 is not, as you can see, the 20.85 because it references cell H6, which is the H6. Hold on. which is the 20.85. I don't know why I put that there, which is N2, whatever. So it references the 20.85 and it subtracts from it R2, the R2D2, the expense, right? So it's 20.85 minus 1.26, which is 19.59%, right? We good with that? So let me just fix that, so it's not confusing. Q2. Okay. Wow. Oh, because now I remember why I did that, because Q2, so better. Because that's not formatted right, the 5.75%. So that takes, well, why did I do that? It is 20.85. Tourage, N2. Yeah. Sorry, guys. And not that, why am I even spending time on that? Who knows? Yeah, okay, fine. Okay, so as an IY in your calculator, if you don't mind, type in 19.59. You know where I got that from, right? Type in 19.59 and hit IY. So we got the PV, we put in N, we put in the payment as 0, we put in IY, we put in 4 out of the 5, compute future value. What do you guys get?
$28,196.81.
Excellent. Excellent. You did it right. Did anybody not get that?
Would the answer be positive or negative?
Okay, great question. So if your present value is negative, the answer is positive. If your present value is positive, the answer is negative, because I'm showing negative as present value because the money's leaving me. So I'm calling that negative, right? I'm investing it. The 28,000 is coming back to me. So it's going in a different direction, hence a different sign.
Okay, thank you.
Yeah. Any other questions? We good with that?
Yeah.
Okay, cool. So now let's go to the second example where this is a no load fund, right? No load. So the 5,000, all of it is going to work for us. So on your calculators, type in 5,000, hit present value. It's 10-year term, that doesn't change. Payment is 0, that doesn't change. But our interest rate is this 18.29% minus, again, they charge a lower fee every year, right? Instead of charging 1.26, they only deduct 0.85%, which is, again, really good, right? I mean, so the difference is the 18.29 minus 0.85, which is 17.44. So type in your calculator 17.44, hit IY. Now compute future value. What do we get?
$24,953.44.
Excellent. Okay, did everybody get that? So all of this to show what? Here we start off at a disadvantage, right? Only 4,700 bucks goes to work for us instead of 5,000. We're paying a higher annual fee, 1.26% instead of 0.85. And we still end up with more money. So it's the perfect example of the opposite of what I've been recommending, right? I mean, again, you know, hey, I happen to come across it, I got to share it. Even so, but theoretically, do you guys get that if all your money goes to work for you and your expense rates, annual expense rates are lower, it increases the chances of you getting a higher return, right? Right? In this case, it didn't. But in general, as a rule. So I love the fact that I came across the one example that didn't fit my theoretical model. So I used to have a chemistry professor who, and I hated chemistry because, you know, I would do certain things and he'd give us whatever the chemical law was or rule. And when I did the experiment, I came up with a different answer. I mean, I came up with an answer which is, hey, the law doesn't apply in this case. And he would look at me and say, Edazati, the exception proves the rule. I hated that. I hated that saying. I hated that saying. What's the point of having a rule if there are exceptions to it? But now, of course, older and wiser, I get what he's saying. The fact there is an exception means that there is a rule. Otherwise, it wouldn't be an exception. Otherwise, it would always be true. So here's an example in finance where I am now my chemistry teacher. Class, the exception proves the rule. God, I never thought I'd ever say that in my life, but yes, here it is. I said it. Questions? We good? Can I see some thumbs up?
Yeah.
Yeah.
Okay. All right. I don't know why I'm in a good mood. I'm just laughing. A joke came to my mind. Can I share a joke with you guys?
Sure.
Okay. This has nothing to do with anything. It's just a joke that came to my mind, and I'll get serious. Trust me, pretty soon. But this young man is having a conversation with God and asks God, God, what is 1 billion years like to you? And God replies and says, well, it's like a second is to you. And the young man's kind of like, wow. Thinks a little bit further and says, God, what is $1 billion like to you? And God replies, it's kind of like a penny is to you. Again, thinks a little bit longer and then says, God, can I have a penny, please? And the response is, in a second.
I get it. I get the joke.
And you know, yeah, I love that joke. And you know, I am wagering that if you put a penny in your calculator, I mean, I don't think, and N is 1 billion, right? And your interest rate return is 12%. You'll have more than $1 billion at the end of 1 billion years. I'm wagering. I haven't done the math, but I would think. Yeah, I hope you didn't get offended by that joke. I just thought it was great. Can I have a penny? Please. Sure, in a second. Where was I?
That made my day right there.
Oh, thank you. It made my day too when I heard it. Thank you. I'm glad you liked it. So let me go back to sharing. And I think that kind of covers what I wanted to do about mutual funds, right? I think so. And now I want to talk a little bit about bonds. We good with that? Can I move on to bonds?
Yeah.
All right.
Yeah.
So a bond is an IOU. It's a way that companies or governments borrow money. What they do is they give you a piece of paper, a bond certificate that says, hey, I'm going to pay you this much money, say, at this day, sometime in the future. Meantime, I'm going to give you a certain amount of money every year. what will you pay me for this? How much will you give me in exchange for this promise, right? So a bond is a piece of paper that has 3 pieces of information on it. And is my Excel sheet visible? Can you guys see this?
Yeah.
Yeah.
Okay. So one of the pieces of information on it is it's a dollar amount written right on the face of that piece of paper, and therefore it's called face value of that piece of paper. And it's also the maturity value. This is the dollar amount that they're promising to give you on maturity or at that date in the future. So that's step number 1. And so in this example, I'm using $1,000, which is, you know, a typical increment in which bonds get sold. I mean, you can't buy a bond for $25. Yeah. Fair enough. So typical minimum amounts are $1,000. Now, wait a minute. If you have a mutual fund that invests in all kinds of bonds, you can buy a share in that mutual fund for $25, no problem. Immediate diversification, professional management, blah, blah, blah. All right. But here we're looking at not a mutual fund, but an actual bond certificate. So one of the things on that bond certificate is the amount that they promise to pay you at the end, right? When it matures, that's called face value or maturity value. The next thing that it has on there, it gives you the maturity date. This is the day that I'm going to give you the $1,000, which in our case is 10 years from now. Fair?
Yeah.
And then the third and last item that is on there is a percentage, which is called the coupon rate. And I'm saying 6%. I made that up. I mean, everything is made up here, obviously. So 6% coupon rate. And what you do with that rate is you multiply that rate that's on that sheet of paper, that IOU, that bond, you multiply the 6% by the face value. 6% times $1,000 is $60. It won't tell you $60. It'll tell you 6%. But the only thing you'll use that 6% for is to determine how much money is that bond going to give you every year, right? So 6% times face value is $60. And this is called the coupon rate, and the 6%, which you use to find the coupon, which is the $60. Now, usually bonds pay their coupons semi-annually, so they're actually going to pay you $30 every 6 months. Questions so far? In this example, it's $30. They pay you half of that amount every 6 months, half of the full year's payment. Questions? How are we doing? Easy, right? I mean, so far. Okay.
Yeah.
Awesome. Okay. So now let's do some math. Let's say bring your calculators out. So the $1,000, the face value, is what the bond will pay you when it matures at the end, right? So on our financial calculators, where would you put that $1,000?
FV.
FV, future value. That's what you're going to get in the future. And this is a contract, by the way. The company's promising to do that. So now, if they're not around 10 years from now, they're not, how they're going to pay you, right? But if they're around and assuming they're still doing okay, they're promising to pay you $1,000. So $1,000 is future value. Absolutely. We good? Yes? No?
Yeah, we're good.
Okay. So now the next thing is let's say it's a 10-year bond. So what would N be? Not a trick question.
10-year bond? Is that what you said?
Yeah, yeah, that's what I got right here. 10 years,
Oh, then 10.
10, right? And forget about the for now, the semi-annual nature of the coupon payment, because you know if we're going to do that, then it ought to be 10 times 2, 20. But for now, we're just going to keep it simple. Fair enough. And what is our payment every year? What are we going to get? In my
60.
example up here, $60, right? So far, so good. We're going to get $1,000 when it matures. It'll mature in 10 years time. That's N. And between now and maturity, every year, we're going to get $60. We good, class?
Yeah.
Okay. So we got payment of 60, N of 10, future value. And let's say when the bond was issued, I mean, when the IOU was issued, how the heck did they come up with 6%? Well, that's the market rate, right? The other companies, same kind of investment quality. When in this fictitious example, for them to, you know, they're willing to pay 6%. So to compete, right now, you got to be willing to pay 6%. So 6% is the market rate, right? So market. So I guess market should be in quotes, but anyway, are you guys okay with that? So put your IY at 6, please. Future value is 1,000, N is 10, IY is 6, payment is 60. We got 4. Calculate PV, please, present value. What does your calculator say? Class?
I got $116.78.
Okay. Let's just double check the math, right? On your calculators, now let me pull up my app. Forgive me. Should have done that earlier. Okay, so on the bottom left side of your calculator, you know, is the clear button, and above it is recall, right? RCL. Agreed?
Yeah.
So press recall and then press N. What do you show?
I got 10.
Excellent. Press recall and press IY. What do you show?
6%.
6, not 0.06, right? 6.
Yeah, 6.
Excellent. Press recall and press payment. What do you have?
60.
60, right?
Yes.
Good. Positive, right?
Yes.
Okay. And press recall and press future value. What do you got?
Got a negative 1,000.
Ooh, positive.
Positive.
Yeah, make it a positive value. Why?
Because that's the money we'll be getting at the end of the
It's coming to you.
maturity.
Just like the $60 is coming to you, the 1,000 is coming to you. They're both going in the same direction, right? To you. Fair?
Yeah, I got you.
Okay. Now compute PV. What do you get?
Okay, now it's negative 1,000.
Okay. So what that means, wait, okay, good job. Rest of the class, what do you guys, what do you have? Do you have minus 1,000?
Yeah.
Okay, so if the market is a 6% rate and you have an opportunity to buy or lend money to a company that's going to pay you $60 a year, and at the end of 10 years going to pay $1,000, that's worth $1,000. You'll lend them $1,000. At the end of 10 years, you get your 1,000 back. In the meantime, you get $60 a year, which is a 6% return. That's what the bond is worth. It's worth $1,000. Fair? I didn't mean to overcomplicate it. We good?
Yes.
All right. Now, this here on Excel, I got the formula up here, right? The PV value. So if I change any of these four, it'll change the PV. So let's say if I have 9 years left, I mean, a year later, right? I got 9 years left and market rate is still 6%, still going to pay me $60. Going to get future value. I get $1,000. What do you think the PV is going to be? Let's do it. 9. It didn't change. Still 1,000. Fair? Fair. All right. I'll answer my own question. So let's say now the market rate goes up. I mean, when you bought the bond, market rates were 6%. Let's say a year later, rates went up. Up to what? Give me an example.
Uh, 10%.
All right. So let's say they go up to 10%. And no matter what happens to the rates, I'm going to get $60, right? That won't change because that's in the contract, right? On that piece of paper. And no matter what happens at the end, at maturity, I'm going to get $1,000. That's not going to change. We okay with that? Right? And we got, let's say we got 10 years left. Wait, what is that bond worth now?
$754.
So let me talk you through that. So market rates are now 10%, right? That's what I'm hypothecating. That's the example where you guys gave me the 10%, but market rates are now 10%, which means that any investor wanting to invest in bonds now and lend money to a company, right, buy a bond, that company, the market, they'd have to offer them the bond at 10%. Now, wait a minute, you're now already invested in a bond that is paying 6% because that's what interest rates were when the bond was issued. And you want to sell, you don't want to hold on till maturity, you want to get out. How are you going to sell a bond that gives a 6% return when the market's giving a 10% return? I mean, why would I, as an investor, be okay with a 6% return if I can get 10? Well, answer is I wouldn't be okay, right? What? I got stupid written on my head. I mean, I'm going to get the most I can get. So how are you going to convince me to buy the bond? You're going to sell it to me at a discount. And if I, as an investor, paid you $754 for that bond, I get $60, right? Just like that's the contract. And at maturity, I still get the 1,000. So at maturity, I get $245.78 more than I put in, right? Right? I only put in 754. I get $245.78 more. I get $1,000. That extra that I'm getting bumps up my yield and bumps up my yield effectively from 6% to 10%. What do you think?
Yeah. So why does bump it up?
Because I'm not only going to get the 60, I'm going to get more money out than I put in. I only put in 750. I get out 1,000,
Oh, okay.
right? In the first scenario, I put in 1,000, I get out 1,000. The only thing I get is the 60 bucks extra, right? That's a 6% return. In this example, because I'm buying the bond at a discount, I'm gonna get the 1,000 that is promised to me on a piece of paper, but because I paid less than 1,000, I therefore gain. Yes?
Yeah.
Okay. So now let's say interest rate's gonna go down. Where are they gonna go down to? Instead of going up to 10, they're gonna go down from 6 to what? Give me a number.
4.
Okay, 4%. And again, let's say we've got 10 years left. $1,000. Look what happened. Now I get more. I can sell my bond for a premium. Let me talk you through that. Market rates are 4%, right? Any bond that is issued now, when rates have gone down, they'll pay you 4%. They're not going to pay you 6, because why should they? Market rate has dropped, right? They can get away with paying you less. Fair? So they're going to pay you 4%, and now you're sitting on a piece of paper that pays you 6. Now, me as an investor, do I prefer a 4% return, or would I prefer a 6% return? Not a trick question.
The 6%.
Absolutely, right? So you for whatever reason, you need money. If something's come up, you want to sell the bond. You don't want to wait 10 years to get your money back. You want to sell it now. And so, hey, let's say you say, anybody want to pay me $1,000? And I would jump in and say, absolutely, I'll pay you 1,000. But somebody else in the market would say, well, I'll pay you 1,001. Mine offers better. Another person said, don't listen to those idiots. I'll pay you 1,002. And it gets bid up, right? Because it's better than a 4% yield, until it gets bid up to 1162.22. At this point, you're going to get the 60 bucks, which is better than 40 bucks. But when it matures, you're not going to get your 1162 back. You're only going to get 1,000 bucks. You're giving up $162. That money that you're giving up effectively lowers your rate from 6% to 4%. Did that make sense? No?
That makes sense.
Okay. So do me a favor, let's do this on your calculators. So the future value doesn't change, right? Because they're going to pay you $1,000 in 10 years time. Let's not make n change. Let's keep it at 10. The 60 bucks they pay you every year, that's not going to change, right? Because that's in the contract. What changed is the market rate changed. And this time the market rate is 4. So put in 4 and press IY. Now compute PV. What do you guys get?
Negative 1,162.
Okay. So you got the same answer, right? Let me just share something with you guys. So we're going to put these values here on the left so we don't forget them. And let's do the second one too. Change I from 4 to 10. Type in 10, hit I, compute PV. Class, are you following?
Yeah. I got 754 and 22 cents.
Perfect. Good job. Good job. Anybody not get any of these numbers I have on the board here on the Excel sheet? Speak out, please. If you have a different number. Okay, going once, going twice, moving right along. So what you'll notice, right, if rates go up from 6 to 10, the value of the bond went down from 1,000 to 754. When rates went down from 6 to 4, the value of the bond went up. So bond values do the opposite of what interest rates do. When interest rates go up, bond values go down. When interest rates go down, bond values go up. It's an inverse relationship, which we've just demonstrated. Agreed?
Yeah.
Okay. Now let me show you another thing. Let's say instead of a 10-year bond, I have a 30-year bond. We good? So I'm going to change N in my first example from 10 to 30. Remember when I changed it from 10 to 9, it didn't have an impact, right? Market rates were the same. Now I'm going to change it to 30 and surprise, there's no impact, right? If I'm going to get my $1,000 back 30 years from now instead of 10 years, but in the meantime, I get $60 every year. So my return on this investment is 6%, which is the market rate, right? So I'm willing to pay $1,000 for that. We good?
Yeah.
Now what happens though, if rates go up and I have 30 years left? Remember, at 10 years, it went down to 754. At 30 years, whoops, it gets discounted even more. See it? And then if rates go down, the premium is even more. Do you see it? 1345 instead of 1162. Now Disney issued a bond. Have I told you guys about this? That was, guess how long the bond was for? The maturity of the bond. Guess how?
Century.
Yeah, it was 100 years. They issued a piece of paper saying, hey, I'll pay you $1,000 100 years from now. And people bought that piece of paper. They lent money to Disney for 100 years. Why? Because they thought they're not going to be around. Their kids are not going to be around. Maybe their grandkids are not going to be around. But their great-grandkids will be around. And at some point, great-grandkids, people will still be taking their kids to Disneyland. And will still go see Disney movies. And will still buy Disney toys. Disney as a company is gonna last, is the opinion that they're expressing by lending money to Disney and are okay with not getting repaid for 100 years. Fair? And also part of that opinion is that other people will think the same way. Pardon me. So even though they may want to get out in 5 years, get their money back, there's somebody else who's going to share the viewpoint that 95 years from now, Disney's going to be around. And they'll find somebody to sell that paper to. We good with that premise?
Yep.
All right. So now look what happens. So here's what I'm going to do. Let me copy this. Copy that over to here. So this is 30-year bond. Oops. And this was a 10-year bond, right? So now I'm going to change it to 100 years. You ready, class? It went down further, right? $600 instead of 700 or 622. And if rates go down, it went up by more. Do you see that the amount when rates go down, the amount that the value of the bond goes up by is more than the amount by which the value of the bond goes down by when rates go up. In other words, it's not a straight line relationship. So when rates went down on a 10-year bond, and so let's do this. This rates went up by 10%. I should have done something different. My bad. So let's make them, so that's up by 4. Let's make it go down by 4. Let's make this 2%. And let's change this to 30. Sorry, guys. So I'm changing the rates by the same amount. 4% up versus 3%. Oh, come on, Taraj. So this is plus / minus 4%. Right? If rates go up by 4%, how much did this change by? It changed by $131. If rates go down by 4%, it changed by $700. See the difference? $131 further decline versus $733 further increase. Or relative to the 1,000, no, sorry. The rates went down by 245 relative to rates went up. Hold on. Let's make sure my math is right. 754.22. $254. And 62. So when rates went up by 4%, this bond value dropped by $245. When rates went down, this bond value went up by 162. And what about here? This rate, get the signs right. And this rate So here on a 10-year bond, the impact when rates went up was worse, right? A $245 decline versus only a $162 increase. Oh, no, I knew that was wrong. Wait a minute. Was it wrong? 6, 2, 10. That's the 10. I got the wrong number there. Stupid boy. All right. Oh, shoot. I thought I was going insane. Sorry, guys. Okay. Rewind. So 10-year bond. Can you guys come back to me? Sorry. 10-year bond. If rates go up by 4%, it drops in value by $245. If rates go down by 4%, same amount of change, the increase in value is $359. The increase in value is more than the decrease in value. Yes?
Yeah.
Sorry about that. Hellacious confusion there. And with a 30-year, same thing. If rates go up by 4%, the value reduces by 377. If they go down by 4%, the value increases by 895. Again, the value change is greater when rates go down than when rates go up. It's not linear. It's kind of like convex. So as rates go lower, if you have rates on the horizontal, the value of the bond on the vertical, as rates go lower, the value of the bond goes up by more. It's a steeper curve. So it's not a straight line. It's a curve that gets steeper as rates go lower. Okay, you got to have questions after that terrible lesson.
Yeah, could you go over that again?
Sure. So when the bond got issued, we paid $1,000, but we're willing to pay $1,000 for it because market rates were 6%. You okay with that?
Yeah.
Okay. If between the time it was issued and sometime in the future, rates have gone up, let's say they go up by 4%. If rates go up, the value of the bond goes down. On the other hand, if sometime in the future rates go down relative to when they were issued, when rates go down, the value of the bond goes up. So far, so good?
Yeah.
Okay. Now, the amount by which the bond value goes down for a given change in rates is less than the amount by which the bond value goes up for that same change in rate, but different direction, right? So when rates change from 6 to 10, that went up by 4%, the bond value oh, I'm looking at it.
I think you referenced a cell wrong.
No, I think I'm good. Just 750. Here's
Oh,
the
Yeah,
754.
you
right?
fixed it because the 10-year the growth it's referencing the what the E39 cell. It was just 1,800, so I think you have to copy the value instead of referencing.
I
like
did
if you
copy
change
that.
like if you change that the n back to 30, it like kind of breaks. You see the 10-year the growth.
Oh, I'm with you. Thank you. Thanks for bringing that to my attention. Thank you. Appreciate that.
No problem.
Thank you. No, that's great. Thank you. Good catch. Okay, now it's good.
Yeah, it's fixed.
All right. So thanks for catching that. So, okay. When rates go up by a certain amount, 4%, the value of the bond goes down. But if rates go down by the same increment, 4%, the value of the bond goes up by more than it went down by. But, right? The change is 359 versus 245. Right? And on a 30-year basis, a 4% increase causes a 377 drop in value. A 4% drop causes almost $900 increase in value, right? The increases happen at a greater rate than the decreases. Did that answer the question?
Yeah.
And those increases and decreases are magnified the longer the bond's maturity is. So with the 10-year bond, the value for 4% raise in interest rate, the value only dropped 245. But if you made it 30 years, the value dropped by more, 377. For a 10-year bond, if the rates go down by 4%, the value went up by 359. But for a 30-year bond, it go up by almost $900. And for a 100-year Disney bond, if rates go up by 4%, it'll drop by $600. But if rates go down by 4%, look, it went up, it almost tripled, $2,700, right? A $1,700 improvement in value relative to $600 decline in value, almost triple. See it? So this is what it means, is that longer term bonds are more sensitive to interest rate changes than shorter term bonds. So another reason somebody will buy the 100-year Disney bond is not just because they believe 100 years from now they get the $1,000 back, but if interest rates go down, they're gonna be making a boatload of money. Now, if interest rates go up, they're going to lose a boatload of money, but they'll only lose it if they sell the bond. Agreed? If they don't sell it and hold on to it, at the end of the 100 years, they'll get the $1,000. That's the theory. These bond gains or losses only occur if you sell the bond before it matures. And if interest rates have changed since the bond got issued. That was the bottom line of all of this. Questions?
So it's basically like you lose slower than you gain. You gain
Yes.
faster than you lose.
Yes. In all other things being equal, right?
Yeah.
And we're just looking at changes in interest rates. Now let's look at this. Where are interest rates right now? They're pretty low, aren't they? Class?
Yeah, I believe like less than 1%.
Yeah. So are interest rates, they got more room to move up or more room to move down?
Move up.
Move up, move up. And if interest rates move up, what's going to happen to bonds?
Start
Buy
to-
less, right?
They're going to what?
They'd buy less.
They're going to be worth less. They're going to drop in value. Right?
Yeah.
So again, it's okay to buy in bonds, but if you think interest rates are going to go up, you don't want to buy a 100-year bond because you're going to get crushed. Maybe you buy a 2-year bond. Does that make sense? Or a 1-year bond, so that, or whatever, shorter term bond. So when the bond matures, you get your money. At that time, interest rates have gone up. You can now reinvest it at a higher rate. Right? So if you think interest rates are going to go up, one strategy is to buy shorter maturity bonds so you don't get hurt as much. In fact, you're not going to get hurt at all if you wait till maturity. So if it's a one-year bond, fine. You get your rate for 1 year. Next. Does that make sense? It's just in general. Now, there are other bond investment strategies. One of them is called a ladder. Let's say you got a 10-year bond. And so you buy a 10-year bond, put 10% of your money in a 10-year bond, or 10% of the money that you've allocated towards bonds in a 10-year bond. Then put 10% in a 9-year bond, 10% in 8, 7, 6, 5, 4. So 100% of your money is distributed, right? 10% 1-year maturity, 10% 2-year maturity, 10% every year maturity until 10 years, right? And then when the 1-year maturity, when time passes, 1 year passes, the 1-year maturity one now matures. Now you got your $1,000 back. And what do you do with it? You buy a 10-year bond, because the 10-year bond that you had a year ago now is a 9-year bond, right? Everything, the maturity shortened by a year. So it's a ladder. So you keep that spread. And that way you get the advantage of typically longer term bonds pay a higher return than shorter term bonds. So you get the advantage of the longer term bond rate premium that you get. And at the same time, every year you get to roll over or, buy another 10-year bond. And so you have it nicely dispersed around that 10-year spectrum. That's called a ladder. Or you can put money in a bond mutual fund and have a bond manager manage it for you. Now, one of the things about this whole present value exercise with bonds is, when we looked at Tesla, there are like 25 million shares being traded for that stock on that day. But bonds are much more thinly traded, right? If there were 25 million shares, then 25 million times $1,000, that's $25 billion in bonds, right? And unlikely for a single company to borrow that much. Now, there's some companies that can, but most, that's a lot. So there aren't that many $1,000 increment bonds out there, much less. So bonds get traded much more thinly than stocks, which means that you got to know what your bond is worth. Because if you sell your bond for market or buy your bond at market, then you could be taken advantage of, right? So you got to know what the bond is. What is it paying? Obviously, what's the coupon? What's the maturity, right? What's the face amount? And then calculate, given today's interest rates, what you think the bond is worth, and then set a limit to it. Does that make sense? When you're selling the bond, if you're choosing to invest in individual bonds, don't sell for market, because there are not that many buyers and sellers out there. And if they find a patsy that they can take advantage of, they will, right? So know in your mind what that bond ought to be worth. And this calculator can help you figure that out, as we just did. Questions? Hope I didn't confuse you too much. I apologize for the formula, whatever, mix-ups or any questions for me? Can I get some thumbs up? I got 5, 6, 7. Okay. 8. Thank you. Thank you. 9. Thank you. Good. I'll take that. Oh, bless you guys. Thanks. Thank you for doing that. So let me now go back to mutual fund. What else did I want to share with you guys? We did that. Oh, yeah. Okay. A couple more things about bonds. So if so companies can borrow money by issuing IOUs, issuing bonds, and our federal government borrows money, right? We're operating at a budget deficit. How is that deficit funded? It's funded by the government issuing IOU notes, right? Series E bonds or treasury notes or treasury bills. And you can take money and lend it to the US government, and US government is of course guaranteed to pay you back because they can print money. They got the money tree, right? So impossible for you not to get paid back, right? They can print money. So now, if the economy goes to hell in a handbasket, that money may not be worth much, but you'll get your money back. So, and because our government, our country is seen as an island of stability. I mean, despite all of, a couple of lunatics, sorry, pejorative word, extremists, couple of extremists rioting or, burning things and, hitting people or whatever. In general, when our transitions in power, back to politics, are peaceful, right? So when Obama came in and, Bush left, peaceful. When Obama left, Trump came in, peaceful. So That's been that way throughout the history of our country. And so this peaceful transition in leadership, coupled with this strong economy that we have in this country, we've all this innovation going on and people always coming up with better mousetraps and just providing superior products, whether it's in the entertainment or tech industry or in whatever, manufacturing. I mean, we if we set our minds to it, we really are an amazing people, a lot of talent. Our presidential candidates may make you think otherwise, but in general, there's a huge talent pool. And so when the US government borrows money, another example of a government agency that borrows money is the state of California or the various states, or Fresno County can issue bonds. The city of Fresno can issue bonds, has issued bonds. So municipalities can issue bonds. So federal, state, or local government agencies can all issue IOUs. Now, one of the things about state bonds, California state bonds, is if you are a resident of the state of California, that interest rate that you get from the state bond, that coupon that you get, that's $60 in our previous example, is not taxed. That income that you get is tax-free. Is not taxed by our federal government, is not taxed by our state government. Now, if the federal government borrows money and you buy a treasury bill, you don't pay federal taxes on that income that you receive when you're buying the bond, when you're lending money to the government, but you do pay state taxes on it. But state bonds are double tax-free, free of state taxes as well as federal taxes. So now what matters when you get the money from the bond is, again, it's not what you make, it's what you keep. So here I have an example where you get $100 coupon or return from a bond that you bought, and this is a bond issued by some company. And let's say your marginal tax rate, remember the tax discussion that we had, marginal is the highest tax bracket you're in, so that's the one that matters in our analysis. Your incremental tax rate is 35% on this extra $100 you got from the bond. And so your after-tax return, what you keep, is $65. You got $100, but $35 goes to the government. You keep $65. So far, so good?
Yes.
So if you make 10%, right, by that company bond, if you have to give 35% to the government, you're really making 6.5%. So this after-tax return is equal to the taxable or before tax return times 1 minus the marginal tax rate. Again, 1 minus, because if 35% goes away, 1 minus 35% is 65%, you keep 65%. Did that make sense? How are we doing with that? Does that formula here make sense to you? What you're left with after tax is what you got before tax times 1 minus the tax rate. That's what you keep, right? What's left after you deduct the tax rate. And if you deduct 35% from 100%, you're left with 65%. So your after-tax rate is 65% times whatever your before-tax rate was. Fair?
Yeah.
All right. So now let's reverse engineer this, right? Let's say you get a state bond instead of a company bond, and the state bond gives you 6.5%, it doesn't pay you 10. But because you don't pay taxes on it, you get to keep 6.5%. So this 6.5% is the same as a 10% before tax return, right? And the way you get that is you take the after-tax rate of 6.5% and you divide it by 1 minus the marginal tax rate. You divide it by 0.65. And if you divide it by 1.65, there it is. Can you see it? 1 minus F12, 1 minus the tax rate. If you divide it 6.5 by 0.65, you get 10%. So that's the formula for converting an after-tax rate, the 6.5, to a before tax rate. So the impact of these state bonds depends on what your marginal tax rate is, right? So if you are in the 25% tax bracket, then the 10% becomes 7.5. But if you only get 6.5% return, then from the state, then that equates to a 9% return. See that? Which is less than the 10% return, right? It's not worth getting 6.5 if you could get 7.5, right? But if your marginal tax rate is 0.45, then this 6.5% return is equivalent to you to a 12% return. So in other words, if your marginal tax rate is 25%, then okay, you pay 25% on a 10% return, you keep 7.5. But for a guy whose marginal tax rate is 45%, even if he only gets a 6.5 return, that to him or her is worth 12% before tax. So people in a high tax marginal tax rate bracket love tax-free bonds, because you get this huge tax break. You don't pay that 45% in taxes. Because if you paid 45, you'd only keep 5.5. But in this case, you get 6.5%. Woot, woot, woot. Am I still making any sense in this late time of night?
Yes, you are.
Yeah.
Okay, thank you, because I'm fading. Let's recap what we, oh, shoot, I didn't talk about retirement funds. Can you guys handle another 10 minutes?
Sure.
Sure.
Yeah, all right, hang in there, 10 more minutes. So I'll talk to you about something called a Roth IRA. Do you guys see this thing that I've got up here? This
Yeah.
thing. I mean, that's not very descriptive. This age 59 and under is kind of the topic, and Roth IRA, right? All right. So an IRA is an individual retirement account. So you can put money aside in an individual retirement account, and you can have a regular individual retirement account, or you can have a Roth individual retirement account. So the benefit of a regular individual retirement account, let's say you put $5,000 in it, you can invest it in whatever you want, stocks or mutual funds or whatever you want. But that $5,000 that you put into the regular retirement account is tax deductible. It lowers your taxable income. That's cool, right? And then your investment in that IRA hopefully will grow, right? Over time. It's not there for you to touch, wait until you retire. But over that 40-year time frame, it's going to go up, and every year you can add more money to it. And it goes up, quote unquote, tax-free. Every year you do not pay taxes on those gains within that IRA investment. Like your IRA is shielded from taxes. The only time you pay taxes is when you take the money out of the IRA. Then anything you take out of the IRA is taxable at your marginal tax rate, whatever it is. Now, if you take money out of the regular IRA before you're age 59 and a half, not only is it taxable, but you have to pay 10% penalty. They take off 10% and they still take whatever you got to pay the taxes on the 100% that you took out, right? So if you're in the 45% tax bracket, you got to pay your 45% tax and the 10% penalty, 55% out. Did that make sense? That's a regular IRA. Questions on the regular IRA, even though I'm showing you a Roth IRA on the screen. I was talking a regular IRA. Did you guys understand that?
So taxes come out after you pull it out?
Yes. Yes. When you put the money in, you get to deduct that from your taxable income. But when you take the money out, it gets added to your taxable income.
Okay, thank you.
Yeah, you're welcome. So it's kind of cool that you can deduct your initial investment, right, from your taxable income. That means you pay less taxes, right? If you put 5,000 bucks in and you're in a 25% tax bracket, then a quarter of that 5,000, 1,250, you pay 1,250 less in taxes. It's kind of like the government is encouraging you to save. Absolutely, right? They're saying, hey, you can pay us later when you take the money out. You don't have to pay us now. Fair?
Yeah.
Okay. All right. So it's a good thing. And a 401k typically works in the same way. If a company offers you a 401k for you to put money in, whatever money you put in gets deducted from your gross wages and gets deducted from your taxable income. Your taxable income reduces dollar for dollar. And so it basically becomes a tax deferred investment. Now, Roth IRA, you do not get the benefit of a tax deduction. So the money you put in a Roth IRA is kind of money you put in after taxes. You already taxed, and now you put the money in. Fair? Why would you want to do that? So here are a couple of reasons that it could be advantageous to you. Whatever money you put into the Roth IRA, only the money that you put in, you can take the money that you put in out without paying any penalties. Now, the earnings on the money that you put in, if you take that out, you pay taxes on those earnings and you pay penalties under most circumstances if you take it out before age 59 and a half. But your actual contributions, after tax contributions, you can take them out at any time with no penalties. So that for some people is an advantage, that you can have easy access to your money. Fair?
Yep.
Yeah.
All right. Now, in addition to the money that you put in, you could take out some of the earnings that you've made with no penalty if you're using that money to use as a down payment for a home purchase. Now, hold on. I didn't set this up totally correctly. The earnings that you make on the IRA, whatever gain on the investments or dividends or interest income, whatever you're getting in that Roth IRA, those earnings are not taxed. Just like in a regular IRA, the earnings are not taxed. In a Roth IRA, when you take your earnings out, that may also not be taxed. If you're using some of that money, you know, here it is, $10,000 lifetime maximum for a down payment from a house. Or if you're using the money to pay for some college expenses, qualified education expenses. Or you're using the money to adopt a kid or to give birth to a kid. Or you use that money because all of a sudden you became disabled. Fair? So that's an advantage to a Roth IRA. And if you've had the money for more than 5 years, then, you know, chances are you can withdraw, your earnings will not be subject to taxes at all if you use it for these purposes. What does that thing up there say? You may be able to avoid penalties. I'm sorry, I misspoke. If you didn't, again, if you kept the money, if you take the money out before you're 59 and a half, but you had the money in an IRA for at least 5 years, you can take out, what I said before is true. You can take out the money for buying a house, education expenses, giving birth, if you're disabled, blah, blah, blah. And you don't pay taxes on your earnings. Under no circumstances will you pay taxes on the money that you put in. That's always available. But even the earnings you can take out as long as you've been in there for 5 years with no tax impact, no penalty impact. If you're there for less than 5 years, you can take money out and you don't pay that 10% penalty, but you do have to pay taxes on the earnings component that you take out. So I got it right. Sorry, it took 3 goes, but I got it right. So I'm sorry, I'm going to repeat myself. Hang in there. Don't hate me. So the difference between a Roth IRA and a regular IRA is the money that you put into a Roth IRA is not tax deductible. You don't get the tax shelter, the tax benefit of investing in the IRA with your initial investment. The tax benefit you get is the earnings that you get on your investment, that increase in investment value that you get. Those earnings grow tax-free. You don't get taxed on those earnings as long as they're in the Roth IRA. Plus, if you take those, you can always take your own money out, no problem, no tax impact, no penalty. But if you take out the earnings and they're used for these purposes listed below, you don't pay a penalty on taking them out. And if you had them for less than 5 years, you do pay taxes on them. But if you had them for more than 5 years, you don't even pay taxes on those withdrawals for these purposes. Now, once you get to age 59 and a half, age 60, right? Past age 59 and a half, then you can take the money out, earnings, as well as the money that you put in with no tax impact. You do not pay taxes on those withdrawals. Did that make sense?
I have a question about that.
Yep.
So if you like take out money like
Yep.
periodically, does it continue to grow whatever's left in there?
Sure. I mean, it grows based on the investments you've made, right?
Yeah.
Yep. Whatever's left continues to grow. Sure.
Okay, thank you.
Mm-hmm. Any other questions?
So when you turn 59 and a half, you can take out money even if it's not for the reasons that you listed?
Yes, for any reason whatsoever. You want to go to Hawaii, go for it.
Okay, thank you.
Yeah, you want to buy a motorcycle at age 59, go for it, right? You know, anything you want. You want to give it to charity, no problem. So that's with the Roth IRA, right? Not a regular IRA. Regular IRA, anything you take out, taxable. Roth IRA, you have all of these exceptions. Again, the only downside is your initial investment doesn't give you a tax break with the Roth. So here's the deal. If you are in a really high tax bracket, God willing, right? You're going to make all kinds of income, right? And you're in a 35, 45% tax bracket, put your money in a regular IRA and a 401k, because you don't pay 45% taxes on your hard-earned money. The government helps you, right? And then the thought is when you retire, right? Because you're not making that wage income anymore, you've retired, your tax bracket is going to be lower. So even though you got the 45% tax deduction, say, when you put the money in, when you take the money out, as long as you don't go wild, you're not going to pay 45% taxes on the money you took out. It's going to be at a lower tax bracket, maybe. No guarantees, right? Government may raise tax brackets all over the place, but all other things being equal. So it's a gamble. But if you're in a higher tax bracket, my recommendation would be put it in a regular 401k, a regular IRA. When you're in a lower tax bracket and you're only paying 10, 15%, then or 20%, the tax benefit is not that valuable to you, put it in a Roth. Because chances are when you retire, you're going to be in a higher tax bracket, and then you can take it out tax-free. Something to think about. Questions? So one more thing about retirement is, remember, before you invest, right? I said you got to build up an emergency fund, right? Because the investment is, generally speaking, it's not for something that you need immediately, right? It's for longer term purposes. Now with the Roth IRA, the book says you can even use that as an emergency fund, because you can take the money out without a tax penalty. Your money, not the returns. I think that's a slippery slope. I think that, in my opinion, it's much better to have a separate emergency fund, cash account, whatever. And we'll go over the benefits of that next week when we talk about insurance. That's how you get your real return. So anyway, so that's my thought process, is have a separate emergency fund, and don't touch your retirement account until you retire, or unless you have like a really worthy cause, like, you need some money for a down payment for a house in a Roth case, right? Or you need to cover the expenses of bringing a baby into the world, stuff like that. Pay for education expenses. So now when you're working for a company, a lot of companies offer 401k plans. And even though you're not in a high tax bracket, the benefit of the 401k plans that companies offer is they oftentimes have a match. Meaning, if you put in 3% of your paycheck, right? And we were talking when we were going to become millionaires, we're going to put like 15%, right? But let's say you put 3%, the company's going to match it with 3%. Some companies match with 4%. I mean, you got to look at the matching plan. So if you don't use the 401k, you're throwing money away, because you're not getting the company match for companies that provide that, right? So that's my exception, is even though you don't have an emergency fund, even though you haven't paid off the credit cards yet, as soon as you're eligible to contribute to a 401k, do it. Because if you put in 3% and the company puts in 3%, you just doubled your money. Where are you going to get a return like that? What do you guys think?
That makes a lot of sense.
That's pretty cool.
Thank you. Thank you. So I took a little longer than 10 minutes, but 9:13. Thanks for letting me ramble. And hopefully you got some interesting things and useful things, right? We now know how to calculate the value of bonds and we kind of know how they work and the difference between tax-free versus taxable income. And on mutual funds, talked about load funds, no load funds, right? Open end, closed end, and now we talked a little bit about retirement accounts. So hopefully this was of value to you. And with that, I'll stick around for any questions, but have a great week and I'll see you next Thursday. And we will talk next Thursday about insurance.
Thank you, Professor.
You're welcome.
you.
Thank you.
Thank you.
Have a good night, Professor.
Good night. Good night.
Thank you, Professor.
Night.